Morning viewers, this is your tutor CPA James Coffee, and today we are going to be proceeding with our series with financial reporting, and we are going to be looking at Ifrs 16 leases. And allow me take off my video so that you can be able to concentrate. We are saying that when you are looking at these standards, we've completed so many standards so far, but today we wanted to look at some of our new standards within financial reporting, and this is Ifrs 16. It is a new standard which was effective in January 2019. And when you look at a new standard, when it is coming in, just note it has replaced some of the standards, and we are seeing that Ifrs 16, that is the leases, replaced IS 17, where we used to account for these leases. But when this new standard came in, there are certain items that have been changed, as we are going to be looking at them. And you are going to be seeing what are the upgrades that were made as far as accounting for leases is concerned. Basically, what we are going to be looking at in this video is how do we understand when someone says we are going to be talking about leases. What are leases? In terms of the definition, we are going to look at how we account for leases and what are some of the parties that are involved within the lease agreement or transaction. We are going to be seeing how each of these parties are going to be accounting for the leases in their perspective, and we look at the recognition. We said when you're looking at the recognition, those are the conditions that are supposed to be met before we say that you have a lease. Then when you look at that, we can also look at the measurement. Having recognized that you are going to be having leases, how are we going to measure, or which costs are we going to assign to these items as we are incorporating them into our financials? Having looked at the measures or the measurement basis, we shall also look at the recognition exemptions. What are some of the leases that are out of the scope of the IO, or that are not supposed to be accounted for, as we are going to be seeing? What are some of the recognition exemptions that are given to some kind of leases or some kind of lease arrangements? And we are going to be looking at the last part will be around the lease sale and lease back. If at all you have been owning an asset and you have sold it out, but after selling it out, you realize that you need that asset back, and then you lease it again. how are we going to be handling certain items, or how are we going to be accounting for those transactions. Then maybe the last bit of it will be the lease modifications, if at all some of the items within the lease agreement are going to be changing. Maybe if the payments, they were supposed to be paid at a certain date, and now instead of paying at a certain date, they have been either increased or the period has been reduced. All of that we shall be seeing them when we are doing the lease modifications. Without wasting more time, let's kick off and we see how we are going to be accounting for these leases for the start. And we are saying that IFRS 16 leases replaced IAS 17, and it was effective 1st January 2019. And we are looking at this as a new standard that was introduced in, because it is one of the, by far it is one of the newest standard. The second one was IFRS 15, that was living from contracts with customers. That was the second newest, but this one is the recent one that replaced the IAS 17. Previously in IAS 17, we used to account for leases and we categorize them into the operating and the finance leases, as we are going to be seeing. But when these amendments were done, when you are accounting for certain items, you may find that we are going to be eliminating all that. So basically, if you are to have any trial number, make sure it is above the 1st January 2019, because the previous computations or questions were based on the IAS 17, which was replaced. So if it was replaced, it means the questions that are set below 2019, they are going to be basing on the old standard. So you take note of that when we are reading or when you are getting some questions from different question banks. So we are saying under this new standard, leases, we have the parties. One, we have the lessor, that is the person who owns the asset, and we have a lessee, depending on whichever pronunciation you are going to be going with, but one of the party is the person who is owning actually the asset. And we have the lessee, who is the person that is just who is just obtaining the right to use the asset, or is the one who leases the asset. And when we are talking about these leases, mainly we are talking about these long-term assets that can be having a useful life that exceeds 2 years. Because if you are talking about these leases, however much they are divided into different types, as we are going to be looking at them. But when you are trying to look at these leases, we are trying to look at some of the non-current assets that can at least stay for more than a long period of time. So let's try to look at the definition wise. what are leases? And we are saying a lease is a contract or part of a contract that conveys or transfers the right to use an asset for a period of time in exchange for a consideration. What we are looking at here is that when you're talking about these leases, they are just an agreement between the person who has the asset and the person who is going to be using the asset. So we expect that the lessee is going to be acquiring the right to use that asset over a given period of time. The given period of time may not necessarily be the whole useful life of the asset, but it may be for a given period of time. And that person is going to be paying a certain amount of money, either on a monthly basis, either annual basis, or quarterly basis, depending on the agreement that has been made between the lessee and the lessor. So that's basically what you should know about the leases. It is a contract or part of a contract that conveys or transfers the right to use an asset for a period of time in exchange for consideration. Meaning that the other person may not actually take the ownership of the asset, he may be using the asset for a short period of time, for a long period of time, but at the end of the day, that person is making a certain amount of money, or what we call a contribution. That's the amount you are paying for you to acquire that right of using someone's asset. When we proceed, we can try to look at we are saying Ifrs 16 states that a customer has a right to direct the use of an identified asset if either, so these are basically some of the criteria that we use for someone to make a decision that a person has a right to an asset. Or when a lease is existing, we expect that if the person has leased out some assets, we expect that for us to be sure that they have actually leased out the asset, we look at some of the two criteria. One, we are saying that they obtain substantially all the economic benefits from the asset, from the use of the asset. Meaning, if you have actually leased out the asset, you are able to get whatever, or to do, or to generate whatever income you wanted to get out of the leasing of the item. If, let's say, you have leased out the asset, you have acquired the asset, maybe to manufacture certain items, we expect that you are going to be delivering those benefits after you have actually leased out, after you have leased the assets. The second thing, the second criteria is that the customer has a right to direct how and for what purpose the asset is used throughout the period of use. Here, what we mean is that if actually you have acquired a right to use the asset, it means you are responsible for what you are going to be doing with that asset. If at all the asset is leased and you have acquired the right to use that asset, you should put it to any purpose you want. No one should make a decision that you are supposed to do A, B, C, D with the asset we've actually given to you. But that should be within the time, or should be within the lease period. The lease period is actually the duration of the lease. If you have actually acquired the asset and the asset is going to be with that person for maybe for 5 years, for 10 years, that's basically what we are meaning. That when you have acquired the right to use the asset, you are supposed to determine whatever purpose you are going to be doing with the asset. Those are basically the criteria that we could base on to say that the person has actually acquired the right to use a given asset. So when we proceed, we are trying to look at how do we account for leases in the books of the lessees, the person who have actually acquired the right to use someone's asset for a given period of time. How is that person going to be treating that asset they have acquired within their financial, when they are preparing their financial statements? Of course, you know, when you have actually leased out when you have leased the asset, it means you have not actually bought the asset, but you have just acquired the right to use that asset for a given period of time. So how are we going to be accounting for these for these assets that we have acquired under a lease arrangement? And basically, this is what we are going to be looking at, or this is our main focus as far as the standard is concerned. Because basically, when you look at the side of the person who are the owner of the actual owner or the lessor, you find that for him is going to be receiving maybe different amounts at a different date. We are going to look at how the lessee is going to account for the assets they have leased, and we are going to also to look at how are we going to be accounting for the lease in the books of the lessor or the person who actually giving out the right to another person. But our main focus, as far as the standard is concerned, we are based on the books of the lessee. That's the person who is actually acquiring the right to use the asset. Okay, basically what we are going to look at, how is the standard, or what are the criteria that are set by the standard on how we are going to be accounting for these leases in the books of the lessee. We are saying Ifrs 16 abolished the distinction between an operating lease and a finance lease in the financial statements of the lessee. We spoke earlier that previously these leases, they were using the IS 17, they were categorized between the operating leases and the finance leases. But when this new modification was done, Ifrs 16 abolished the distinguish how different we used to differentiate these leases into the operating leases and the finance leases. And when this new standard came in, we are now combining all the leases in the books of the lessee, we account for them as they are all the same. So basically, when you are talking about the accounting for the leases by the lessee, we are looking at how the person who has acquired the right at the initial stage of, or at the initial recognition, when you have just acquired the right to use the asset. How are you going to be recording those assets that you have acquired? And we are saying that initial recognition, when you have just acquired the asset, we are saying at the commencement of a lease, the lessee accounts for two items. We have two items that the lessee accounts for as far as the standard is concerned. And one, the lessee is supposed to account for the right of use asset. The right of use asset is actually the asset, or the value of the asset in use. The actual asset the person has acquired the right to use. So basically, when you're talking about the rights, the right of use asset, we have certain items that we are going to be accounting for as far as the acquisition of those leases are concerned. You know, from when you're acquiring any asset, we are looking at what are some of the costs that are going to be associated within that process of acquiring that asset. Are they going to be capitalized, or some of them are going to be ignored? So basically, it is the same way we used to value these non-current assets under different standards, that will incorporate all the direct costs that are attributed to bringing in the asset to its operation. And here we are looking, when you are looking at the rights of use asset, we are trying to look at what are some of the costs that are associated with the acquisition of that right to use a given asset. And basically, we are not talking about the cost we have actually paid. It's not only the cost that we have actually paid to acquire the right that we are going to be accounting for. There are other costs that we've incurred, as we are going to be saying. So we have certain items that are supposed to be accounted for as far as the asset in use is concerned. One, we have any initial direct costs that are incurred by the lessee. And here we are looking at some of those costs that are directly attributed to the contract. If maybe you have paid certain brokers, you have paid commission to brokers that have helped you to acquire that right, then it's supposed to be added back to the cost of, or to the amount you have actually paid in the contract. So it is one of the direct costs that are attributed to the lease, and they are supposed to be combined so that we can be able to get the cost we have actually incurred to acquire the right of using a given asset. The second item is any payment that has been made to the lessor at or before the commencement date of the lease. there are certain costs if basically you want to acquire, if let's say you wanted to acquire a given asset on a lease arrangement, you may find that there are so many factors that you are going to be encountering on the way to acquire the right to use a given asset. Because first of all, you are not going to be the only person that is looking at acquiring the right of a given asset. There are so many people who are going to come in. You may find that you are required to pay a certain amount earlier before you actually sign the contract, the actual contract. You may find that you have actually paid a certain amount, and by the time you go to sign the contract, you have actually incurred some costs. It happens, like you may find if let's say you've been using the asset, and that asset, maybe the lease term is now expiring. By the time you say that I want to renew this contract, most of the time most people pay even before the contract expires, so that by the time the contract expires, they have already acquired, or they have already secured their possession within the bid to acquire another lease term. So if you have paid any amount before signing the contract, then it's supposed to be added to the actual cost you are going to pay after signing the contract. Then the other item we are going to be looking at is any lease incentive that has been received by the lessee. If let's say you have received certain amount of money from let's say the lessor, you may find that by the time you are acquiring maybe a given asset, if let's say you are going to be acquiring, or maybe if you are going to be hiring or leasing a given warehouse, you may find that you need to design the house or the warehouse to the extent that to a standard that you see it is going to be better for the operations you are going to be incorporating in. And it may happen that you may tell maybe the person who is giving you the warehouse, and you find that the person cannot modify or do the necessary repairs to make sure that the asset looks exactly as how you want it to be. You may find that the person who is giving you the right to use that warehouse may ask you to pay a certain amount of money, maybe to renovate the warehouse to reach the standard that you want. And by the time you come to sign the agreement, you'll find that the house has already been renovated, but they have actually used your own money. It means that money is going to be deducted from the cost that you are going to be that you are going to be incurring when you're actually signing the contract. So if you have made certain amount of money before, and that money is going to be refunded back to you at the time of signing the contract, then it's supposed to be less. The other incentive we may talk about, if let's say you've got a discount, you may find that the person is supposed to give you maybe the lease amount is supposed to be maybe 10 million, and you find that the person is saying, instead of giving me the 10 million, that you just give me this, maybe 8, and you find that 2 million that you've been exempted, we are supposed to less it from the costs that you have actually incurred, so that we can be able to incorporate in the actual figures that you have actually incurred. Then the other one is a lease liability. This lease liability, we are going to look at it, but basically lease liability is actually an obligation that you are going to pay a certain amount of money in the future. Because when you're looking at the accounting for these leases by the lessee, at the initial recognition, the lessee accounts for two items. That person will account for right to use or right of use asset, that is the actual asset in use, and the lease liability. If at all you are going to be making some partial payment, and the money, the other amount that are going to be, you are going to be submitting them at a later, maybe at a later date. Those there are two items at the initial recognition. But this lease liability is inclusive or is included within the cost, that is within the cost of the right of use asset, because it is part of the money, it is part of the consideration to acquire the right to use the asset. It is within the components that are making up the right of use asset. And the last one is going to be the estimated cost of dismantling and restoring the sites. This one we shall look at it in details, but what you have to understand as far as this is concerned is basically that these costs that we incur, if let's say you are going to be using maybe land, you are going to be leasing out land, you'll find that at the end of the useful life of your lease term, you'll be required to restore the site, or to make sure that you maintain the site as the way you found it before you acquired the lease, or before you acquired the right to start operating on a certain ground. This is mainly in the mining and oil drilling. You find that these people, when they are removing the minerals, they are disorganizing the land, and by the time they remove their minerals, or by the time their contract expires, you find that the surface is disorganized. So what will happen is that you will incur certain costs at the end of the useful life of the contract, or at the end of the lease term, to make sure that you maintain the level of the land to the extent that it looks exactly how you found it before you started the operations. So if there are those costs that we estimate that maybe in the future we are going to be incurring these costs to make sure that we are organizing the land how we found it, then we shall also incorporate them within the cost of the right we have acquired. And when you sum up all those, excluding the incentives, then you will be able to get the right of use asset. That's basically at the initial recognition. That's what the lessee accounts for. The second item that the lessee accounts for is the lease liability. This one we spoke about it, but maybe to add more on that is that a lease liability, this comprises of all payments outstanding or not yet paid at the commencement date, but they are discounted to their present value using the interest rate increased in the lease or any incremental borrowing rate. Here, what we are trying to look at is that since these costs are going to be paid in the future, if you want to incorporate them within the cost, we have to discount them to get their present worth now. And the only way we can do that is by using any given discount rate that will be stated in the question. That is basically what the lease is supposed to account for at the initial recognition when you have just acquired the right to use the asset. Then we try to look at subsequently now at the reporting date. The other one was initial measurement, what we actually include when you have just acquired the right to use the asset. But what are some of the things, or how are we going to be accounting for these two items, the right of use asset or the actual asset in use and the lease liability at the end of the year? Which figures are we going to be incorporating into our balance sheet and all that, balance sheet and financial statements? Because the figures we've been talking about, they are at a point when you have just acquired the right at the commencement. But now, when the year ends, we have to report these items at the end of the year. So what are the figures that we are going to be incorporating in our financials as far as the right of use asset and the lease liability still in the books of the lessee? And we are saying that for the right of use asset, that is the actual asset in use, we are saying that subsequently the lessee shall measure the right of use asset using the cost model under IS 16 PPE, or property, plant and equipment. What do we mean by saying we are going to be using the cost model? As the same way we do it in IS 16 PPE. What we are meaning here is that we are going to be depreciating. Of course, because if you are looking for the figures that you are going to be including in our financials, we are looking at what are some of the expenses that are going to be incurred on the right of use asset that are going to be included in the profit and loss. Then the balance is what we are going to be taking to our balance sheet. And now we are saying that when you are depreciating these assets, we depreciate it in two ways. One, we use the straight line, but basically when you are depreciating this right of use asset, we depreciate it in a sense that the useful life you are going to be using of that asset should be based on two factors. One, if at all the asset is going to be sold at the end of the useful life of the at the end of the lease term. If at all the lessee is going to acquire the ownership of that asset at the end of the lease term, if the person is not going to acquire the ownership or is not going to buy that very asset, then we depreciate that asset over the shorter of either the lease term or the useful life. if the person is not going to acquire the asset at the end of the lease term, we compare the lease term and the useful life of the asset, and we take whichever is lower or whichever is shorter of the two. If maybe you find that the useful life of the asset is 10 years, but the person has leased the asset for 5 years, if at the end of the 5 years, the person is not going to buy that asset, then we take, when you are calculating the depreciation of that asset, we take the shorter, which is 5 years as the lease term. But if the person is going to buy the asset at the end of the lease term, what we consider is that we are going to depreciate that asset using its useful life. Because the implication is that if at all the person is going to acquire that asset, even though the person has a lease of, let's say, 5 years, and the useful life of the asset is 10 years, it means that the person is going to be the actual owner, or the person is going to use that asset for the whole 10 years. So it doesn't make any sense to depreciate the asset using the lease term, yet the person is going to stay with the item until it reaches its useful life. Because even if there are these buildings, you find that the building has maybe a useful life maybe of 15 years. And you find that the person is going to use that warehouse maybe the person has leased that warehouse maybe for 5 years. You find that those 5 years will elapse, and yet the asset is still having more 10 years to reach its useful life. So if the person is not going to acquire the asset at the end of the lease term, then we expect that the asset is going to be depreciated using the shorter of either the lease term and the useful life. But if the person is going to acquire the asset at the end of the lease term, then we don't care about the shorter of the two. We just take the useful life of the asset. That's basically one of the ways we can subsequently measure or account for the right of use asset. Then the other way is by the lessee can also apply the IS-40 investment property. If at all the asset is an investment property, and we use the fair value model. Because as we saw from the IS-40 investment property, we say that subsequently the investment properties are accounted for, or they are subsequently measured at fair value. So we use the fair value model, or we may use the revaluation model. We may use the revaluation model under IS-16, but basically, as far as the standard is concerned, most of the times we use the cost model to value these right of use asset. So that's basically what we use to value these right of use asset using the cost model. And we said that when you are using the cost model, we take the cost, we less the depreciation, so that we can be able to get the carrying amount that is going to be taken to the balance sheet, and the depreciation will be taken to the income statement. But how do we compute the depreciation? Is by either comparing whether the person is going to buy the asset at the end of the lease term, or the person is not going to buy the asset at the end of the lease term. If the person is not going to buy the asset at the end of the lease term, we take the shorter of the useful life and the lease term. Secondly, if the person is going to buy the asset at the end of the lease term, we take the useful life to determine the depreciation. So that's how basically we account for the right of use asset or the actual asset in use. And the third note is going to be on how do we now subsequently account for the lease liability. Remember we said the lease liability is going to be, initially is going to be discounted and we'll get its present worth. After getting the present value of that asset, of that future sum you are going to be paying in the future, that was at the initial measurement or at the initial recognition. But what figures are we going to be taking as a lease liability in the balance sheet or at the end of the year? What we are saying is that a lease liability will be amortized over the lease term, and we split the financial costs or the interest. And when we split the interest, then the remaining part is going to be the lease liability, and that lease liability is what we shall be taking to the balance sheet. But we compare the financial cost or the interest and we take it to the income statement. Basically what we are looking at is we are just spreading the future sum or that present value we've got to the lifetime, to the useful life of the lease. If the lease term was maybe 5 years, we spread that lease liability over the 5 years. We get the component of interest and the component that is going to be actually on the point of the lease amount. Because what will happen in this lease, when the money is going to come in the future, it means if the money is coming in the future, the person will charge you more amount than actually what you are going to be paying right now. Because you may find that by the time you pay that money in the future, maybe inflation will be there and the money will lose its value. So that's basically why we convert it to determine its present worth, and we also try to separate what are some of the components that we are relating to the finance or the financing cost. But basically in the financing cost, we are interested about the interest rate, the interest component. So that's basically what we are going to be looking at. And we are saying if there is a change in the lease term, lease amount, discount rate, or anything else, then the lease liability must be remeasured to reflect all the changes. This is what we shall look at under the under the lease modifications, if at all there are changes that are going to be made within, maybe the lease term is going to be adjusted, the amount you are going to be paying is going to be adjusted depending on, because if you adjust the period, it means you have to adjust the amount someone was going to pay, maybe on a monthly basis, annual basis, depending on how the contracting suggests. So if that happens, then it means we have to redefine or remeasure the lease liability. That's basically what we shall look at when we go to the lease modifications. But let's try to look at what are some of the some of the recognition exemptions. We said under these recognition exemptions that there are some leases or some types of leases that are not required to go through all these steps when we are accounting. If maybe the lessee acquires these leases, we account for them differently. The person is not supposed to account for the right of use asset, the lease liability, and they are basically in two types. They are all this standard permits only two exemptions, and we have one is leases with the lease term of 12 months, that's 1 year or less than, with no purchase option. If at all the lessee leases these assets for less than a year or for 1 year, and the person has no option of buying at the end of the lease term, then we don't go through the other routine way we do when we are accounting for these other leases. Then the second one is the leases where the underlying assets have low value when they are new. Basically, what happens is that the standard doesn't disclose what do they actually mean when they're talking about assets of low value. But basically, when you're trying to check these assets, they are talking about the asset which is below, which is at least, or something which is below $5,000. At least you may say that is a low asset. And maybe some of the examples we may talk about the computers, these personal computers, maybe some items of furniture, these small items. Those items, they are not supposed to go through the previous ways we've seen how we account for these leases. But the question is, if at all those assets are not going to be going through that procedure of accounting for a rights of use asset and the lease liability, then how are we going to be accounting for them? And we are saying that for the above leases, lease payment will be recognized on a straight line basis over the lease term. Meaning what we do for these, we just spread the costs over the lease term. If the lease term is for 1 year, we divide the cost we are incurring. If we divide by 12, we get what we are going to be paying every month. That's how basically we account for that under the books of the lessee. But now, having seen how we account for those leases under the books of the lessee, or the person that is acquiring a right to use the asset, let's also try to look at how are we going to be accounting for these leases in the books of the lessor, or the person who actually owns the assets. If you try to look at the books of the lessor, we are trying to recognize that since this person is also going to, first of all, is going to lose the assets, since the assets are going to be given out. Secondly, we are seeing that the person is also going to be receiving some money upon giving out these assets. So how is that person going to be reporting, or how is the person going to do to prepare those financials? And we are saying that here the lessor continues to classify leases between finance and operating leases. This is basically what the old standard was talking about. What the old standard was giving is actually being brought to the books of the lessor. And we are saying that for the lessor, in the books of this person is going to classify these leases between finance and operating leases. Finance leases, those are actually, these are the leases that are going to take almost the useful life of the asset. If the person is leasing these items for more years, more or less taking all the useful life of the asset, and the person is going to be, at the end of the day, you may find that the person may actually take or may actually buy the asset at the end of the lease term. If, let's say, the asset had a useful life of 10 years, but the person is leasing this asset maybe for 8 years, and at the end of the 8 years, the person is willing to buy the asset. Those are basically the assets that are going to be within the financing lease. Then the other operating lease, those are the leases that are taking lesser period. If maybe the useful life of the asset is let's say 10 years, but the person is leasing for the asset, leasing for that asset maybe for 2 years or 1 year. And at the end of the day, the person is not going to buy these assets at the end of the useful, the lease term. So what we are basically saying here is that the lessor will continue to separate or classify these leases into finance and operating leases. And we said finance lease is a lease that substantially transfers all the risks and rewards incidental to the ownership of the underlying assets to the lessee. If they are talking about these risks and rewards, mainly if a person is acquiring a given asset, there are some risks that are associated. If at all I sell to you a given item or an asset, there are certain risks, maybe theft, they may steal the property. If maybe you lease maybe a truck, and you find at the end of the day they may steal the car, that's a risk, because you are actually the owner of the asset, meaning we've transferred everything, all the risks and the rewards. And maybe in these rewards, we may find that at the point of transfer, or when I have actually transferred my asset to you, you may find that these assets, it may increase in value. And you end up, you paid less money, but the asset gained more value in the market. And if you are to sell that asset at that time, you find that you are going to be making profit. Those are maybe the rewards, the way you can talk about the rewards. Meaning we've actually transferred all the risks and the rewards incidental to the ownership of the underlying asset to the lessee, meaning it's like the lessor has given up all the asset. So if it is If it is to account for leases in the books of the lessor, it means the lessor is going to separate these assets into the finance and the operating. So if it is a finance lease, how is the lessor going to account for it? Because we've actually seen that the person is going to give up the ownership of the asset. So if the person is giving up the ownership of the asset, it means the person is also going to derecognize the asset, because the asset is no longer belonging to that person and it will be belonging to the other one. So if it is an operating lease, it means the person is going to be continuing to record the asset in his or her books, because the person still has the ownership, other than the finance lease. So maybe to try to clarify more on the finance leases, we try to look at what are some of the examples of situations that indicate that a lease is a finance lease. One, we are saying that the lease transfers ownership of the asset by the end of the lease term. That's what we've been communicating, that at the end of the lease term, the person is going to be the owner of that asset. Secondly, we are saying that the lessee has the option to buy or to purchase the asset at the price that is lower than its fair value at the date the option becomes exercisable. What this means is that you may find that the person you have actually leased the item may be for, if let's say the lease asset is for 10 years and the person has gotten a lease for, the lease term is for 8 years. But within the contract, someone suggests that at the end of the day, you may buy this asset if at all the lease term ends and you feel that you want to be using the asset. So it means that even the other 2 years that are going to be remaining to the useful life of the asset, you may find that this person will be charged less compared to what the person would have paid if they are to buy off the asset. Thirdly, we are saying that the lease term is for major part of the economic life of the asset, even if the title is not transferred. What this means is that if someone leases, if maybe the asset has a useful life of 10 years and the person leases that asset for 9 years, it's like the person has actually bought the asset, because at the end of the day, even if you don't sell that asset to that person, it means by the time the person leaves the asset or the person ceases to have a right of using the asset, it will also be very old. At the end of the day, if it is a car, you may find that maybe it has gone now to it has actually lost value, and you can't even modify it, and you can't even use it. It's like the person has almost bought the asset, because if the useful life is 10 years and the person has released the asset for 9 years, it means the person is actually bought the asset. Then the fourth point we can look at is that at the inception or at the commencement of the lease, the present value of the lease payment amounts to subsequently all of the fair value of the leased asset. If maybe the asset you are leasing out, if you are to put it in the market now, you find that the value they are going to give you under the lease arrangement is almost the same value that they are going to be giving you at the point if we are to sell it now. That's basically this point is meaning that if you are to, at the point of commencement of the lease, if the present value of the lease payment, remember the present value of the lease payment, we said that is the lease liability. Because that lease liability, how it gets to be the present value, it means we have actually discounted it and we got its present worth. If that amount is equal to the amount that the asset can fetch in the market, if at all it's going to be sold, is the same, you find that the asset is actually being sold out, or which gives rise to, or which is one of the indication that we have a finance lease. You find that the person has given you more or less the same amount that you can acquire from the market if you are to sell it out. The last one, maybe we can look at the leased asset of such a specialized nature that only the lessee can use them without major modifications. What this point means is that if at all you have an asset and that asset is specifically for certain items or specifically for producing certain items, and if at all the person leases it out, even if they have not bought it, by the time their lease term ends and they leave you with that asset, you can't use it for anything. And since you can't even use it for anything, and secondly, you can't even modify it, at least to be doing another kind of work. So it means it's like the asset has been sold out, meaning it will be one of the indicators that we have a financial lease. That's basically what we can talk about as far as the financial lease is concerned. But let's look at what are some of the criteria that we are going to be following when we are accounting for these financial leases. Remember, we said in the books of the lessor, these leases are separated within the finance and the operating. So we are now looking at how are we going to be accounting for finance leases in the books of the lessor. That is, basically we start with the initial measurement at the commencement of the lease term. Which values are we going to be recording in our financials? We are saying at the commencement of the lease term, the lessor derecognizes the underlying asset and recognizes a lease receivable in the statement of financial position. What will happen is that if this asset has been leased out or more or less sold out, because at the end of the day, the person will have an option to buy the asset, you will find that this person ceases to be the owner of the asset. Remember, here we are in the books of the owner. If the person has given it out in terms of financial lease arrangement, it means the person ceases to be the owner. So if you cease to be the owner, then you have to derecognize the asset or to write it off from the assets you have. But upon the recognition of those assets, we are recognizing the lease amount or the money, the lump sum amount that you are going to be receiving after selling or after giving out this asset. What happens is that when you are receiving these, they come as a lease receivables. We don't actually receive cash, because by the time you go into a lease arrangement, it doesn't mean that they are going to give you cash there and then. So what we do, when we are crediting the PPE, if maybe the asset was a PPE, when we are writing it off, of course, when you are writing it off, it was debited. So when we are writing it off, we credit it, and then we debit lease receivables. Here we are not debiting cash or bank, because we are not receiving cash at once. We are now recognizing lease receivables. They may take the asset and then they pay us later. So we are saying that the lease receivable equates to the amount not received at the commencement date, but that amount is supposed to be discounted to its present worth. Remember when we said that when you are receiving this money, it's not only the money that you have actually sold the asset, is the amount you are going to be receiving. There are other indirect costs that may come along. Maybe if at all, because if even the person who is selling these assets may also incur certain costs, like they have paid some commission to brokers to look for these people who are going to buy the asset. So when they have incurred those costs, they will also combine with what the buyer is going to give to them. So the lease receivable is going to be a combination of the initial indirect costs, the initial direct costs that are associated with the selling of the asset. But basically, what the amount the person is going to be paying in the future will be discounted, and we get the present worth, so that we can be able to incorporate in the figures. Then, if at all we are going to be initially recording that as a derecognition of the asset and a recognition of a lease receivable, then what will happen at the end of the year, that is now at the subsequent measurement? What are we going to be recognizing at the end of the year? What we are going to be recognizing, the ledger should recognize finance income in the profit and loss account. This profit and loss account is going to be the lease receivable. Remember, we are reporting, or we are preparing these accounts on an accrual basis. Whether we've received that amount or we have not received it, at the end of the date will come. So we take the lease receivable to the profit and loss. That is one. Then the second thing, we are supposed also to reduce that lease receivable by the money that we are going to be receiving, or that we have actually received by the end of the year. Because if you sign the contract, they may give you some part of the money, and when they give you the money, of course, you debit the bank account or the cash. You debit the bank account by the cash you have received, and you credit the lease receivable, because now the part of the money has been received. So you have to reduce the lease receivables. And that lease receivable, the remaining, is what will be taken to the profit, to the balance sheet. After recognizing, of course, we recognize the income. Then let's look at how are we going to be accounting for the operating leases. The operating leases by the lessor. Mainly, you can talk about leases, even if you don't call them assets. It may even happen in these football matches and football players. You find that the person has been given out to a certain club on a loan. And on a loan, they may be having an option to buy the player at the end of the loan period. And the other way, you may find that the person is actually buying the player. And you find that at the end of the day, the club is paying certain amount, even at the point when they have actually bought the player. So like when you look at the likes of Eden Hazard, they bought the player from Chelsea, but at the end of the day, they are remitting some money at the end of each year. Or at the end, there are certain terms that were fixed within the contract, and you find that the club is still paying some money on top of the money they actually paid. You find that the person the club has paid money, but there are some top-ups they keep making depending on different achievements that the player is going to bring to the new club. So those are basically some of the things you can talk about. If it is an operating lease, you find that maybe the person has gone for a lease, and after the lease, the person will go back. So it means the other club will be accounting for the player. These people, they're only accounting for the right. They are just using for that short period of time. We are saying that the lessor keeps recognizing the leased asset in his statement of financial position. The reason why the lessor is now recording this asset is because the asset has not been sold. But what will happen is that when you account that you still have the asset, on top of having the asset, it means you are also going to be accounting for the income you are going to be receiving as a lease income from leasing out that operating lease. And we are saying that the lease income from the operating lease is recognized as an income on a straight line basis over the lease term. This is also like an amortization of the lease amount over the lease term. That's basically there is an example here, but we are not going to go through the example right now. Let's maybe talk about a sale and a lease back. A sale and lease back transaction. What will happen is that you may find that the company, you may find that the company needs maybe to have certain amount of money, but the company cannot actually, or it has looked maybe for other ways of getting this money, but it has not yet got ways. But you find that the company had the assets. If maybe the company has the assets and these non-current assets are there, but they actually need cash, what they can do Actually, this sale and lease back is one of the financing, one of the most commonly used financing tool. You find that the person sells out the asset and again lease that asset back. It is a sale and lease back. And how does it happen? It happens in a sense that if the company has these, if maybe the company has many non-current assets and it wants to get some cash, maybe to push the operation of the business, and they have maybe tried to get money from different sources, but they have actually failed. So what they can do, they can sell off some of these assets. When they sell these assets to the other party, then what they do, the other party will give them cash. But after receiving this cash, they use some of the money they have actually received to lease out. Meaning that the person who was now a lessor will be now the lessee, because at the end of the day, you sold the assets to a given person, and that person is going to give you these assets as terms of the lease arrangements. Also, there are other advantages and disadvantages that are associated with this, but it is one of the ways you can be able to acquire cash. One of the easiest way you can look at is that maybe you can look at a simple example, maybe a landlord selling out maybe the house, and that very same person becomes a tenant of the same very house he or she sold out. So when you have sold and you become a tenant, it means now you're going to be, it's like now you're going to start paying a lump sum amount of money for a certain period of time. So that's how basically we look at how some of these transactions happen. And what we are going to be looking at here is that how are we going to be accounting for these lease, sale and lease backs? The other person who has been now the lessor is now the lessee, and the person who was the lessee is now becoming the lessor. But there are certain conditions, as we are going to look at. If someone is becoming a lessor, what we are going to be looking at is that has the person actually sold these assets, or they have not yet sold them? Because it may happen that I may give you these assets and you give me cash, but when I have not actually sold the assets to you, you may find that I have given you these assets as a security for you to give me cash. Then after getting your money, I pay you back, you give me the assets. So if at all the person has actually sold the asset, how are we going to be treating it? If the person has not actually sold it, because if you're selling, it means it is going to come as revenue, meaning it will be accounted for under Ifrs 15, that is revenue from contracts with the customers, as we are going, because it is going to be our next standard that we are going to be looking at. So if it is not a sale, how are we going? Because if it is not a sale, then it is supposed to be dealt with under the IFRS 9, those are financial instruments and all that. So we are saying that a sale and leaseback transaction involves a sale of an asset and leasing the same asset back. In this case, the seller becomes the lessee and the buyer becomes the lessor, as we discussed. What I'm more interested in is how are you going to be accounting for them? The accounting treatment of a sale and leaseback depends on whether the transaction of an asset is a sale under IFRS 15, that is 11 from contracts with the customer, or whether it is not a sale. So these are the two scenarios. The first scenario, if it is actually a sale, you have given up the ownership of the asset to another person. Now we are saying that the seller is going to be now the lessee, accounts for a right of issue, a right of use asset. That's basically how we've been doing it, but this time around, the person is going to apportion. How are we going to be apportioning? Because remember, you are going to be receiving, you've sold these assets, but at the point you have actually sold these assets, we've been depreciating these assets. So we have to compare. If you're selling these assets, are you selling them above the carrying amount? Carrying amount will mean the net book value of the asset. Because by the time you've been using these assets and you've been depreciating them. If you have been depreciating them, it means that the assets have been reducing in value. So we shall need to know, have you made a gain when you have sold these assets? And we are saying that the seller accounts for a right of use asset at the proportion of the previous carrying amount related to the right of use retained. Then we shall also compute a gain or loss will be recognized only to the extent that the right to the extent related to the rights transferred. Then the buyer is now going to be the lessor, because after buying, it's going to give you and you start paying back some money on under lease arrangement. So what the buyer will account for a purchase of an asset, because you have actually sold the asset. The other one is going, first of all, you are going to recognize the asset. Then the other one is going to recognize an acquisition of an asset. Then this acquisition of this asset is going to be accounted for under different standards, or that asset is going to be accounted for under different assets. Maybe if the asset was falling under PPE, that is IS 16. If the asset was falling under IS 40, investment property, and all that. So the asset will be accounted for under different standard, and the next thing we shall be accounting for, it will be the lease. Now the lease will be accounted for under IFRS 16, as we've been saying in the books of the lessor. Meaning this person now will take the other previous steps we've seen of how the lessor accounts for that lease. This is how we are going to be computing the right of use asset, and we are saying the carrying amount of asset over the fair value of the asset will multiply by amount of the lease liability. We said we are going to be apportioning most of these items because by the time you've sold those assets, you are depreciating them for certain amounts. So it means when you're taking the figures, we take their carrying amounts. Then we also determine the gain. Of course, when we are getting the gain, we shall get the fair value of the asset, what you have actually got from the market. We less the amount of the lease liability, then we divide by the fair value, we multiply by the total gain. That total gain is supposed to be apportioned. Then lastly, we can look at how are we going to be accounting for a transfer that is not a sale. When you actually given out maybe the land title of the land, maybe to a financial institution or maybe to a bank, and you want now to get money. Remember, you give out the title as a security and the bank gives you money. It doesn't mean that when the bank gives you money, it has actually gained control over the asset. No, it means that for them, they're just using the asset as a security for the money they are giving you. So by the time you take back the money you've got plus the interest, then they will give you back the land title. If maybe it is a logbook, you had a car and you are now giving out the logbook to the bank for the bank to finance whichever percentage they are going to give you. But when you pay back the money, then they will be able to release all the documents that you have actually given out. And we are saying that the seller keeps recognizing transferred assets and accounts for the cash received as a financial liability. This is going to be under Ifrs 9, that is financial instruments. And then the buyer will recognize financial assets under Ifrs 9 that will amount to the cash paid. That's basically what we are going to be looking at. We are going to do computations, and that's how we are going to be getting all the other aspects that are remaining. The next standard is going to be Ifrs 15, that is 11 from contracts with customers. And when you have actually exhausted these computations and we've learned how to deal with the leases, then we can be able to take off from there and we'll proceed to the Ifrs 15, that is 11 from contact with customers. Hope you can be able to subscribe and share, comment. Also let others have a benefit. Thank you.